thank you, Kim, for that introduction. I really appreciate it. I'd like to first read a disclaimer. Information presented is for educational purpose only and is not intended as and may not be relied upon as tax, legal, investment, or other advice. PINSCO performs the duties of a custodian and as such does not evaluate, recommend, or endorse any particular investment opportunities. You are advised to consult your professional advisors for specific guidance regarding your investments. Investments are not FDIC insured and are subject to risk, including loss of principal. I'd also like to mention that we also have with us today Paul Bleed, a CPA and partner with Eisner Amper, who also will be contributing with some additional information with respect to the presentation. So thank you for joining us as well, Paul.
Thank you. I'm glad to be here.
So starting off a little bit about PINSCO Trust. PINSCO Trust has been in business since 1989. We have a little bit over 45,000 clients with 10 plus billion in assets under custody with 40,000 unique asset types on our platform. And you'll understand a little more what unique asset types means as we get through the presentation, as we can explain a little more in depth and detail of what a unique asset actually means and what is actually allowable to be invested in using a retirement account. Okay, so moving forward with some of the benefits of self-directed IRAs. As the name implies, self-directed IRAs empower the owner or someone appointed by the owner to make an investment decision. In addition to traditional assets such as stocks, bonds, self-directed IRAs open with PINSCO also provide access to alternative assets. There are a number of tax benefits to using an IRA with these investments, such as tax-deferred growth with traditional IRAs, tax-free growth within Roth IRAs, as well as allowing the freedom to pursue your preferred investment strategy. As far as the tax benefit goes, you can choose from a variety of different individual types of retirement accounts, namely a self-directed traditional IRA, a SEP, a Roth, or even a 401k as well. Tax-deferred earnings in traditional IRAs are tax-free, and distributions within Roth IRAs tax-deferred earnings in traditional IRAs, as well as tax-free distributions in Roth IRAs, as well as being able to take advantage of your 401k rollover. What this allows is a lot more control over the investment types that you're investing in. Allows you to diversify your portfolio, invest in what you want, the way you want, and see your money at work, as well as closely monitor your nest egg. I like to explain to people what we do is we allow them to invest in what they know. If I'm a real estate professional and I understand real estate, well, I want to have my retirement money working in something that I know versus the stock market that I don't quite understand or I'm not quite sure of which options to choose. But I know real estate. I know what a house costs down the street. I know what I can rent it for. I know what the potential appreciation is. If I'm a technology person or an entrepreneur, same thing. I know technology. So myself and my friends may be starting new companies. And what we do is allow them to, number one, raise capital for their own entities inside of using retirement accounts, as well as be able to benefit as an investor using their own retirement account within their founders round, as well as through the multiple series throughout the life of the investment. Obviously, this creates greater flexibility. You're not confined to exchange-traded investments. It allows you to get inspired by tens of thousands of opportunities that are out there, as well as hold traditional assets and alternative assets in the same IRA, thus minimizing your overall custodial fees. PINSCO has seen tremendous growth in alternatives inside of IRAs. PINSCO's assets under custody have grown as IRA owners increasingly look to alternative assets in search of higher returns and greater diversification, as well as just from what I call our general Did You Know campaign. A lot of folks don't even know that you can use a retirement account to invest in these types of assets. So a lot of times it's a very eye-opening experience when they first hear about it and want to learn more. Comparing self-directed IRAs. Not all IRAs are the same. As an example here, a traditional versus a Roth. A traditional, your contributions are generally tax deductible. Your earnings will generally grow tax deferred, but are taxed upon withdrawal. And there are no income limitations. All distribution, you have required distributions or required minimum distributions starting at age 70 and a half. With Roth IRAs, there is no, they're not tax deductible as far as the contributions go. Earnings generally grow tax deferred and are not taxed upon withdrawal after age 59 and a half. far as income goes, adjusted gross income must be below certain limits. Distribution are not required at any age unless it's an inherited IRA. There are a number of tax advantages to using IRAs. With PINSCO self-directed IRAs, you have the freedom to buy almost any form of real estate or private equity depending on your relationship to the actual entity. From real estate, you can do long or short-term residential properties, commercial properties, trustee notes, mortgages, tax liens, raw land and lots, real estate options, additional types of property such as farmland and boat slips as well. You're not allowed to use or purchase any type of real estate that you're actually going to benefit as a natural person. You have to think of yourself as a natural person, as a totally separate person from your IRA. And if one benefits from the other in any way, typically it's a prohibited transaction, and we'll get into that a little bit later.
Point out on this slide that the 35% combined federal and state income tax rate is probably on the low side for an assumption for those living in California and on the East Coast, New York, New Jersey, where the combined rate is much higher when you throw in top marginal federal rate and the high state taxes that they pay.
Thank you, Paul. Roth IRA conversions and how they work. You don't need to meet income requirements for a new Roth IRA. A lot of folks think that a lot of accredited investors or high net worths typically think that they can't contribute to a Roth, which a lot of times is actually true. But that doesn't mean that you can't convert at any time. All you need to do at the end of the day is pay the income tax upon conversion from a traditional IRA to a Roth. And then once converted, just like any other Roth, it will grow and later withdraw retirement assets tax-free. If you have a private equity investment, as an example, that you think may have a multiple X type of return, it might make sense to pay the tax up front and do the conversion to a Roth and make the investment using that Roth in order to get the tax gain from that potential multiple X return investment. So you can minimize the amount of taxes that would be paid on exit. All right, moving on. Growth strategies with self-directed IRAs. What are some of the things that I can invest in? Well, as stated a little earlier, private equity investments in IRA tend to always make sense. Essentially, what can I choose from? Limited liability companies, LLCs, as well as limited partnerships, LPs, private common stock, preferred stock, options, rights, warrants, private hedge funds, fund of funds, convertible notes, and more. As you can tell here, there's as we're speaking about a little earlier in the presentation with respect to 40,000 unique assets, you can see where how flexible and the types of options that are available to you when using a retirement account. Private equity investing in crowdfunding. This is a very interesting space right now in the sense that with the Jobs Act, as well as new technology entrepreneurs, there's been this new access, if you will, to these non-traditional assets that have not been made public and have typically been held to the good old boy type of network. Well, crowdfunding is changing that altogether, as well as changing the way people raise money, in the sense of not using as many VC firms and looking at different ways to raise capital and still retain as much ownership of their own entity and control of their own entity while still getting resources from their partners. Using IRA funds to provide financial backing for small startups or entrepreneurs has been increasing as we've progressed it with respect to our advertising of the did you know that you can actually do this. Most folks don't even know you can do it. So as they know, it's kind of a no-brainer, and people are jumping on board immediately. The other half of it is with the democratization and access, that's also brought the ability for investors to diversify across multiple asset classes with smaller participation limits, where you used to have to put $250,000, $500K, $1 million to have access. Well, that's changed pretty significantly now. And now you have the ability to participate at smaller levels and still be able to participate in these potential high-yielding investments. The growth of crowdfunding platforms make it easy to find your next deal. The national accreditation currently being reviewed by the SEC, and several states have enacted intrastate crowdfunding, and many more are still considering it. Very interesting space. There are a number of benefits of private equity investing. Private equity investments in IRAs have grown increasingly prevalent for several reasons. Number one, the potential for higher returns. Over the past 10 years, average private equity returns have nearly doubled those of the equity markets. Secondly, portfolio diversification. Private equity markets have exhibited historically low correlations to public markets, as well as, at the end of the day, what I think is probably the biggest one is the tax advantages of using a retirement account to invest in these high-yielding assets. When private equity investments are held in a tax-advantaged IRA, already compelling returns can be even more rewarding. There's obviously the potential for higher returns. Private equity can deliver higher returns than public equity markets, and you always want to grow your private equity portfolio tax-deferred if possible, or even better, tax-free within a Roth. Private equity and direct versus indirect. There are two primary ways that a self-directed IRA can invest in private equity. Either number one, investing directly into a company, a startup, for an example, or various angel investments as well. Another strategy is investment in a fund, whether it be a feeder or be a direct private equity or a fund that will wrap up multiple assets, such as within Breakaway, if you wanted to create an LLC where you wanted to have maybe 5 of your friends participate at a $10,000 commitment, you could put together a LLC that you could actually all be a member of, or your IRAs would be members of, if you will, which could then, as the underlying asset, invest into a private equity, or either one private deal or multiple private deals, which makes a lot greater simplicity in minimizing the amount of participants on the cap chart for the sponsor, as well as minimizing the amount of fees that each client would pay. Prohibited transactions and fraud issues, always the fun topic. What am I allowed to do, and who can I do it with? As far as disqualified parties go, any lineal or descendants of their spouses are typically prohibited. So you, your spouse, grandma and grandpa, those types of folks are all disqualified parties. Funny enough, your brother, cousins, they're all allowable as far as being able to either participate in a deal or to be able to lend or borrow from that party. Disqualified transactions or disqualified types of assets or transactions. Directly within Publication 590 from the IRS, they clearly state what is actually disqualified, which we've put up here in front of you. All collectibles, life insurance products, and bilateral settlements. It's never a good idea to bet on death with your retirement accounts. S corporations, general partnerships, as well as auction transactions. So going back to the unique asset slide at the beginning, you can really see how you can pretty much invest in just about everything except the things that are on this actual list right here that we're staring at. Due diligence is always a very important step when investing just investing in general. So what are a few things that we should take a look at with respect to due diligence? Self-directed investors are responsible for evaluating all potential alternative investments, and it's important to ask the relevant suitability questions from the outset to detect any potential investment fraud. Some examples: what is your typical investment philosophy? Does this investment match my investment goals? How will this investment make money? What are total fees to purchase and maintain? Is the company making money? What are specific risks? So there are a whole slew of number of due diligence types of questions that are always great to go over. And typically, an advisor or family office might be able to help you out with that with respect to due diligence. Choosing an IRA custodian. Not all IRA custodians are the same. A lot of custodians will say they're custodian when they're actually an administrator or a facilitator. So it's really important to do your due diligence on which custodian that you use, that they're actually a true custodian, and not just either an administrator or facilitator, because it will impact the amount of fees that you pay at the end of the day, because they're all multiple parties. It's very important to have custodian as an actual custodian itself. So thank you for your time today. I really appreciate it. I'm happy to answer any questions that you may have. If you have any questions moving forward down the road, please feel free to reach out directly and ask for Travis Majors, and I'm happy to answer any questions that you may have. Thank you for your time.